dealer first. I'll explain why I say that in a minute. So you have dozens of credit scores. You have dozens of them. So just because you see your FICO score, since this person absolutely knows FICO versus Vantage and where you can get them from, you see your FICO score from, one of your credit cards, or you call Discover and you got your FICO score, or, you have some program where you get your FICO score. So you know the difference between the two. But you have dozens of FICO scores. Now, none of those programs gives you all of the possibilities for your score. Nobody does at all. You get that, I guess we'll call it the general FICO score. You get your general FICO score. So you see that, so you have, more, you've got a bunch of them. So not just from the three main, credit bureaus. So you got TransUnion, Equifax, and Experian, and you think, okay, that's three right there. But within each of those three, you have different scores. So that's what happens when you, start looking at your credit score from different places. If you just happen to have a buddy somewhere that works at a mortgage company, and you got another buddy that works at a personal finance place, and you got another buddy that works at a credit card place, and you call them all and ask them, what's your credit score, and they looking at your credit, then they're all going to come back with a different number. And here's why. Credit scores are also industry specific at some times. So some industries have their own specific credit score. Now the system basically works the same, but they're industry specific. Just because you pay your mortgage on time all of the time doesn't necessarily mean that you do so with all of the rest of your bills. You may feel that, hey, I can't get put out of my house. I'm never going to make this payment late. But you cannot have that same attitude about a credit card or even a vehicle or whatever it is. So some of the things are industry specific. And a car and dealing with vehicles, that's industry specific. So that's the reason that your score would be different. Now, this time it happened to be lower, but it's potential that it could have been higher as well, but it happened to be lower for you. So we dug a little deeper to see, well, then why would it be lower? Why at all would it be lower since I've got, good credit and, I don't even have a car payment at this particular point in time. So found out that after some back and forth that she has an 8-year-old car. She paid it off almost 4 years ago, and she has a good payment history. Generally had one late payment, and that was kind of early on when she first got the vehicle. So one, it's still on her credit report. She paid it off, like 4 years ago. It's still on her credit report. Good accounts, especially, because that's a good account. Even though she had one late payment, that's a good account. Stay on your credit report for 10 years, and that's helpful for you. So it's on her credit report. She has that one late payment. That's of course still reporting, but the further it is away, the older it is, the less hurt it gives to you. And like I said, she has excellent credit, so it's not hurting her at all. And so since she had those things, then that's why that her car score was different and it was lower. It just was. So because you have a couple of little things on there, with the late payment, but also it's been some time since you had a vehicle. So everybody that's like out there and they're like, okay, I buy my car, I keep my car for 10 years, then I go in, I get a new one, that's financially smart and all of those things. Absolutely it is. It's not helpful for your credit score necessarily, because they like to see that you're making transactions. They want to see those things. And so since she had made a transaction regarding a car on a monthly basis for, almost 4 years, then, they don't have as much data to pull from about how she would be with that. Even though everything else is good. Like I said, she has excellent credit. Everything else is good. When it comes to this industry specific type of thing, that's what happens, and that's why that score was. So since her scores for purchasing vehicles and since they are industry specific, she got the car, and she still got the car. Of course, she got it at a great rate. She was just surprised that her FICO score is a 760, which puts her in an excellent range, right? But at the dealership, she had a 720. Well, and I in my notes I put only, and I put that in air quotes. That it was a 720. So she got the 720 score. when it came to her car, but her FICO score is a 730. And that could happen. It's 40 points. And that's a lot of points. That could happen. But here's the thing, too. So even though we talk about excellent being 750 and above, some places and then some industries have a different range, if you will, as well. So at 740, in some places, even some mortgage companies, at 740, you're considered excellent instead of at 750. Some places, 760 starts excellent for them instead of 750. And with some auto dealerships and auto financing, 720 actually starts excellence for them versus it being 750. So there are differences. All of these things are not just in a vacuum, and it's very strict, not all the time. So generally speaking, yes, anything under 600 is going to be bad. 600 to 650, that's going to be poor credit, and so on and so forth. But Toyota, for example, they can do what they want if they're going to finance their own cars. If they want to say our good customers are 720, then they can make it 720. If they wanted to say our good customers are at 700 based on the data and the people that buy our cars, then we're going to give them the best rates when they walk in here with a 700. They have the autonomy to do that. And so this person got a good rate anyway, regardless, but it was 720 versus 760. And frankly, she just wanted to know what's the deal with that. Quick story about myself, same thing. Over 800 credit score, went to my bank and got my approval at my bank, got me an interest rate and all those things. I don't tell the dealership that I have this, but going to the dealership, doesn't bother me none for them to run it again, because if you have your credit run for a car or for a mortgage within 14 days, you only get dinged once. Let them run it. I don't remember what my score at that time was with the bank. I think it was like 817 or something when the bank ran it. But when I got to the dealership, and I remember the dealership pulled TransUnion, I don't know what my bank pulled, it was 795. So still excellent, but yes, there was absolutely a difference in there from the dealership to the bank, and it'll be the same all the way around for you. No matter where you go, it's going to be different in there. So just take heed, take a beat. Don't worry about this particular scenario. That's not going to hurt you when it comes to your credit at all. All right, so I hope that was clear for you guys. Oh, and I said I wanted to get back to this about not going to the dealership first. So don't go to the dealership first, especially if you have excellent or a good credit. Don't go to the dealership first to get your financing. Go to your bank, some bank, any bank. Go to the credit union prior to you going to purchase your car. So what? You don't know what car you want to buy. You know about how much you want to spend. You know about what kind of car you want. You know what city you want to buy it from or whatever it is. Go to the bank. Get your financing in order prior to going to the dealership. There's several reasons for you doing this. When you walk on a dealership and that nice salesman comes up to you and asks you, so, what are you looking for? And you tell them what you're looking for. Then they say, so how much money do you want to spend on a monthly basis? That's a question you don't want to answer, because then they can figure out how much car you can buy. They can also figure out how much more they can charge you for a car that doesn't cost that much. So you don't want to tell them that, when they start asking, how many years do you want to finance it on? You don't want to answer that either, because all these things, they can financially finagle. And so you don't want to tell them any of those things. If you have your financing in order already, you don't want to tell them that either. You want to just shop around, let you shop around, test drive 6, 7, 8, 9, 10 cars. I don't care. Do what you do, and then you can start dealing with that. Also, when you're dealing with the dealership, and this is perfectly legal, so don't go smacking your dealer upside the head because you went and got a car last week, or you plan on getting one next week. This is going to save you. So also at the dealership, you got good credit, just like this young lady right here. She goes to the dealership, and you pick out your car, you come to terms on what the price is, and then they go back and they run your credit, right? They go back, run your credit. Like this person that we just talked about, just got good credit. Everybody wants to approve her. No problem at all. They all approve her for 4%. So they all approve her for 4%. Your salesperson, after talking to the finance guy, comes back to you and says, great news. Great news. You've got approved for 5.5%. And here's what your payment is. Now, if you already told them, yep, I'm willing to pay $500 a month and no more than $500 a month. That's how people do. That's how we do. I'm willing to pay $500 a month, no more than $500 a month. They come back and they say, look, great news. We got you approved. Now your payment's a little over that $500 you said, but it's only like $515. And so then you start rationalizing your mind. It's just $15. I can find $15. Maybe I'll just stop going to, McDonald's twice a week or whatever it is, right? So you start rationalize that in your mind, and then they tell you, what the rate is. Most people, as long as they're approved, they're happy as a lark, and it's close to the payment that they wanted. They're not really tripping too much off of the interest rate because they got what they wanted. They wanted a $500 payment, and that's basically what they got, right? So that's what happens at the dealership. Bank actually approved you for a 4. Dealership came back and told you 5.5. That 1.5% difference, that check right off the top goes directly to the dealership, and that's how they make additional money, along with selling extended warranties and car washes or whatever else, and oil changes and all the other stuff that they do. That's how they make additional money at the dealership. So you've been warned, you've been told how dealerships work. Now, some dealership, somebody's going to call me up and say, that's not how it works. At my dealership, I worked at a car place and blah, blah, blah. If you were a salesperson, this is not your career, and you worked at a car place for 3 months, 2 years, 3 years, you may not know about the back dealings going on in the finance department. But those are the kinds of things that go on in the finance department. And it's perfectly legal. Congress even tried to address it. It was knocked down. They wanted to stop it, and it was not. So it's perfectly legal. It happens every day, every Saturday when you see all those people in the car dealership parking lots. It happens all the time. So just govern yourselves accordingly. Go to the bank first. Go to the credit union first, especially if you've got good credit. If you've got good credit, there's no way in the world you should let anybody get a half a piece of a percent from you that they don't deserve, because you have done what you needed to do to keep maintain good credit. So I'm getting off my soapbox about that. Like I said, I knew I was only going to be able to get through 3 today. So look, let's check this out. Let's do this last one. Oh, wait a minute. I got a couple more shout outs. Who did I miss? Oh man, I can't miss this guy. Richard Penner. Richard Penner. Today is Richard's birthday. So happy birthday to you, Richard Penner. This is one of my frat brothers. So Phi Nu. He's also from Alpha Chapter, my chapter of Kappa Alpha Psi Fraternity Incorporated. So happy birthday to you, Richard Penner. And I got to give a shout out to a longtime friend. I think we went to, elementary school for sure together, Tommy Burns. So Tommy Burns, I want to say happy birthday to you, big man Tommy Burns. All right. So here's the last one. Then I'm going to let you guys go, right? All right. So this one says, I want to pay off my student loan and my credit cards to help my credit score. The student loans are more than my credit card debt, and I can't do both at the same time. What should I do? All right. Good question. Very good question. And oftentimes we just don't think about it in these specific terms. But when it comes to your credit and when it comes to your finances, they are, they're cousins, but they're not necessarily married, right? Or maybe they are married. I don't know. Whatever they are, here it is. When it comes to your finances, everything that's good for you financially may not be good for your credit score. All right? And maybe even vice versa. Okay? So when it comes to this particular scenario, you want to pay credit cards off or you want to pay your student loan off. One, I feel your pain. I feel you. If you've been paying for your student loans forever, right now, everybody hold up your hand. You've been paying for student loans forever, and you just wish they could go away. You just wish if you had the money, you could just knock them out because you're just so tired of your student loans. I totally understand that. I paid mine off earlier last year, and the closer and closer I got to paying them off, I wanted to just, let me just drop this money on it and get it out of the way. I don't have to worry about making this payment every month from now on or whatever. And that's just not the smart financial move. And the reason that is because like the interest rate is low, and you can't get a lower interest rate than almost nowhere when it comes to student loans. So